Hi. I know that when you look at me in my family podcast or in other avenues, my wife and so on and so forth, I come across as a really responsible guy. And I am a really responsible guy. But I wish I could say that about my 20s. I was very irresponsible with money in my 20s. And we'll talk about today in terms of what I did poorly and what you can do better if you are in your 20s, and what I would do if I was in my 20s all over again. Hi, this is Finance Dad, Shalab Garg. I've had jobs at a bank, at a hedge fund. I currently run my own hedge fund. I know everything there is to know about finance. Welcome to my podcast, and today we will talk about things that I did poorly and things you can do better if you're in your 20s, and also if you've missed your 20s and you're older, how you can course correct, so to say. I did some of that, so maybe I can talk about that as well. In my 20s, unfortunately, I had a really good start to my career in the sense that I got a job on Wall Street in my early to mid 20s. I started to make a lot of money. This was the heydays of Wall Street. In early 2000s, Wall Street is what tech is today. You know how when you join after COVID, or in the recent years, if you join Apple or Google or Microsoft, as a programmer, as an engineer, it must feel like you've made it because these jobs pay very well. You're working with exceptionally brilliant people. The growth opportunities are amazing. They give you stock and this and that. It was the same with companies like Morgan Stanley, Goldman Sachs, and Lehman Brothers in the early 2000s. They were brilliant people. They paid very well. A lot of the money was paid in bonuses. You were cash rich because none of it in those days was deferred. You got paid it all out at the end of the year. At the end of December or early January, you got paid tons and tons of cash. And in early 20s, I just blew it all up. I spent it in shopping. I spent it in Loro Piana. I spent it in traveling. I spent it in, we continued to have kids one after the other, so those took a lot of the resources as well, the kids. But I wish I had done something better with that money at the time. And I did. I really literally just blew it up in cars, in clothes, in real estate. And real estate not as an investment opportunity, more as like summer homes and Hamptons and Westport and Connecticut, all kinds of fun things, but none of it that I would do today. So that brings me to the first point. What would I do differently if I was in my 20s all over again, same kind of career path, Wall Street or a hedge fund, but a growth trajectory of a Wall Street? The first thing I would do is not get caught up in the idea that the income that you're enjoying in your 20s is the growth trajectory that will stay with you forever. I would reconcile yourself to the fact that you may have had a really good start, but it's a marathon, not a sprint. Which means that during a marathon, often you will feel tired, which means often you will find yourself out of a job or between jobs or a run rate of income that will not be as high as you started off with. So what are you supposed to do? The first and foremost thing I would do is to put some of your money every month, month after month, no matter the price and no matter the circumstances, into the S&P 500. S&P 500 trades as a representative of the nominal growth of the United States. Warren Buffett talks about it all the time. You don't have to take my word for it. Take any episode from Warren Buffett of investment advice, and he will tell you that the S&P 500 is the best index that has ever been created to participate in the growth of the economy, in the growth of the country. That doesn't mean that S&P 500 doesn't go down. It goes down all the time. It goes down 10%. There's been 40% corrections in my own investment career in early 2000s and then in the financial crisis. But it always comes back. And you know why it always comes back? Because the nominal growth of the country will almost always stay positive. You're not going to have, yes, some of it could be inflationary, some of it could be real, but the country grows at 3 to 4% a year in nominal terms. So that means the S&P 500, which tracks the nominal earnings of the 500 of the best companies, the most powerful companies of the country, they will continue to grow earnings at that rate, 3 to 4% a year over a long period of time. There will be shocks that the index will have to go through, macroeconomic shocks ranging from leverage, ranging from all kinds of things resulting in drawdowns. But I would just forget about all of those. I would forget about leverage and put down 8 to 10% of your annual paycheck into the S&P 500, no matter the price. And I would do it on a monthly basis. And I'm talking about that above and beyond what you would be doing with your 401k. Some amount of your money every year you will be putting into 401k anyway, and that will probably go into the S&P 500 or something equivalent as well. Now, I would discourage you from the fads of the day. When I was in my 20s, there were a lot of fads too. I'm saying that today, yes, Bitcoin is a fad. All these other fads that exist of today, there were similar fads that existed then as well. And many of them survived, many of them did not. But the S&P 500 was slow, steady, growing at 8 to 10% a year. Every year, year after year, over the course of the 25 years, it's given you 6 or 7x of using compounding, because the money compounds. You put $100 in, it grows to 110 at the end of the year. But the next year it starts at 110. So it doesn't give you 10, instead it gives you 12 on top of the 110. So it compounds, and it slowly and steadily keeps compounding it for you. And by the time you're my age, I'm turning 50 this year, you will have plenty of savings out of that investment idea. The second far, far away from the S&P 500 that I could recommend is some version of real estate, especially the home that you live in. It is worth investing in some kind of real estate property, especially if you're living in it, because you get interest deductions on it from the mortgage, if you take a mortgage on it. And that, I would say, the mix of S&P 500 and to own the home that you live in. And I'm talking about someone who's not blatantly extremely rich. I'm talking about someone who is on a Wall Street career, slowly growing their career path, and getting to a point where they want at 50 to have some kind of a retirement nest egg. I cannot think of a mix of anything better than these two vehicles that I'm giving you. Some money into the S&P 500 on a monthly basis. Forget about the levels and forget about what people are saying. First of all, stop listening to what people are saying, because they have no idea. Banks are corrupt because, think about it. As a bank, let's say you talk to a random bank strategist and they're on CNBC all the time. Whether the market goes up, the market goes down, or the market goes sideways, they're going to get paid their bonuses irrespective. These banks were there in business 30 years ago, 100 years ago, 20 years ago, and they're going to be there in 30 years' time and 100 years' time. In other words, the people that were there 100 years ago, 30 years ago, and today, they keep rotating, but nothing changes at the bank. So you cannot take investment advice, particularly because they get paid by volume. The more transactions occur, the more fees they can collect. So their interest is not in someone like you doing a buy and hold investment idea, where you just put 10% steadily at the end of every month into the S&P 500, because they make very tiny amount of money in that, if any, because the commissions involved or the fees involved in a Vanguard or a Fidelity S&P 500 ETF is almost nothing. I'm talking about 10 or 5 basis points. There's literally no fees compared to any other investment vehicle that these banks would be selling you. Stay away from the banks. Put your money in the S&P 500, and if you have leftover, put it in real estate, particularly the home that you own. Your primary home, you're allowed to deduct the mortgage interest expense from your top line income. That is valuable, because even though real estate may or may not go up a lot as much as S&P 500, but it parks your money into something stable, and against it, the money that you're paying doesn't go pissed away in rent, and instead you're growing equity into the home. Even if the real estate price doesn't go up over a course of 5 or 10 or 15 years, as you pay down the mortgage, the equity that you own in the home will continue to go. So it's a forced form of savings that you would otherwise not do. And like me, you would probably piss it away in holidays and clothes and summer vacations and summer homes and 100 grand in the Hamptons for 3 months. I mean, these are things that they feel very seductive in their 20s, because everybody else on Wall Street is doing it, so why shouldn't you? Clearly you can afford it too. But I'm not saying don't do any of them, because they are fun things. I enjoyed doing them, and we had a home in Connecticut that we enjoyed with our kids quite a bit. So I'm not discouraging you from doing all of those, but the saving into the S&P 500 and into the real estate can be in addition to it. And that's what I'm leaving you with. Put some money away in the S&P 500, look at nothing else, forget about Bitcoin, forget about Nvidia stock. There's always going to be a fad of the day. But those fads of the day will make you a lot of money and lose you a lot of money. But they're not buy and hold investment vehicles the way the S&P 500 is. It gives you, today Nvidia is hot. When I was graduating business school, General Electric was hot. So there's always a fad every decade that comes and goes, but the S&P 500 tracks the 500 of the best of them. So tomorrow, if there's a biotech company that's really, really hot, or some other industry that has taken off, artificial intelligence, so on and so forth, they will take over the index as a weighted portion of it. And you will participate in that portion of the growth. And let's say we go into war and defense becomes really, really big and part of the index. You will participate in that. So on a rotational basis, the index is the most stable, amazing way for you to, and it's diversified within itself. You know how people talk to you about how you have to diversify your investments? S&P 500 is internally diversified. Once you put your money in S&P 500, you don't need to diversify with any other thing. Government bonds are cheap as well today, but on a 25-year-old perspective, someone who is 20 to 25 today and looking to make an investment idea for the next 25 years, I would say forget about everything else, put your money in S&P 500 and try to own the home that you live in. That's Finance Dad for you. You know, I offer a consulting hour, so you know you have information on the box below you to reach out to me. If you want to tailor your investment opinions directly to your particular circumstances, you're welcome to reach out to me. And don't forget to like, comment, and subscribe. I want to grow this podcast. With that, this is Shalabh Garg signing off. See you next time.